But my question specifically is on covered calls, right?
Yeah.
I literally wrote one last week on stock and oil, and I'm having to roll it again this week. Let's just have a broad conversation on just how to approach, covered calls and management of covered calls when the market is aggressively, going to the downside in this example, because we deal with it the same way too, and it's going up aggressively too. We have the same, issue, but
Yeah.
when it comes to market going down aggressively, rolling down those calls, how often, when should you stay in the same month? Should you roll down and go to the next month? Like, let's just have a broad conversation about
Yeah.
that.
All right. So you wrote a cover call in the energy markets last week,
Last week,
right? What was the stock, if you don't mind?
it was on Oxy.
Oxy. Okay. So you wrote a cover call on Oxy last week, right?
Mm-hmm.
You bring in some cash flow, and I'm assuming if you wrote it last week, were you working the monthly?
I was working the monthly.
Okay. I'm assuming you were selling somewhere above 65, most likely 66, 67.
Uh-huh.
Okay. All right. So if you were selling 66, 67, when it comes to the covered call, the covered call is and the cover call for us is the Tackle 25. The Tackle 25 is our covered call system. It's the stocks we like to do covered calls on. Occidental, hey, guess what? Warren Buffett's company, guess what he's probably doing? I can't say for certain because you don't have to disclose sell side mechanics. I'm willing to bet he's writing cover calls on Oxy. I'm willing to bet. He loves his cover call, and so do we at Tackle. So when it comes to the cover call, it's two-part trade: buy stock, sell, rent it out by selling a call option, bring in a little bit of cash flow. I'm not going to teach the cover call here today.
No.
Okay. But in terms of the cover call, the management can be complicated if you allow it to be complicated. But you can say that for anything in the marketplace, or it can be simple if you allow it to be simple. For
Mm-hmm.
me, in terms of the covered call, when the first thing you're managing is the strike price you're selling. Okay. And I'm going to assume you sold this 66 right here.
Actually, I sold the 66 on September
Yeah.
23rd.
Okay. So you sold this $66 call option here. Now,
Mm-hmm.
when you sold that 66 call option, I'm willing to bet it was like a 0.445 delta, somewhere around there. And I'm willing to
Yep.
bet that the cash flow was right around $250, $275, somewhere around
You're
there.
right around that. Yep.
Okay. So in terms, it's like I know Oxy a little bit.
It's like you trade the same stock.
Same system. But in Oxy is a wonderful company, no doubt about that. One of our favorites. But in terms of Oxy, you sold the 66, you own the stock, you sold the 66. Now, the first thing you have to manage is 66, because
Mm-hmm.
that's when you're on the hook at 66. You've sold
Yep.
somebody the right to buy your stock at 66, and I'm willing to bet you don't want to get your stock taken from you.
Nope.
So, I'm not going to have any bad news. You're not going to get your stock taken from you.
Oh, not this month. No,
Not
I'm,
this
I'm
month.
good. I'm safe.
Not this month. You don't need to worry about that 66. But in general, you do,
Uh,
right? And so the first thing you got to manage is 66. And that conversation is one that is centered around intrinsic value versus extrinsic value. And so when you're looking at that conversation, and I go to kind of your intrinsic extrinsic value,
mm-hmm.
if the intrinsic value exceeds the extrinsic value, you're at risk to get your stock getting taken from you, because there's
Right.
actual real value in those options. And
Correct.
so, if, like, for example, just in here, if you had sold the 58, you see how the intrinsic's 36 cents, the extrinsic $3.20.
Mm-hmm.
No, nobody's going to pay $3.20 to get 36 cents of intrinsic, right? And so just think about it like that. Extrinsic is the decaying value of the option. Intrinsic is the real value of the option. But take a little bit of a deeper one. For example, this one down at 54. If you had sold the 54, which you wouldn't have, but let's just go with me on that one. If you had sold the 54, you could be taken from you because there's a lot of intrinsic value. It exceeds
Correct.
the extrinsic value. And so a management technique that we like to do in the Tackle 25 is when the intrinsic value exceeds the extrinsic value in a covered call, you have a decision to make. that decision could simply be, I don't care. I don't care if my stock gets taken from me. It was a position trade. This isn't an investment.
Right.
I'm talking about the mindset here, right?
Yep.
For that position trader, they'd be like, for example, boomerang type trades. A
Mm-hmm.
boomerang trader would be like, yeah, take it from me. I don't
Take
care.
it.
Yeah, take it, please, please, please take
Please
it, right?
take it
But
so I
to
can
the
do it again.
exactly, so I can write a naked put, right? But in terms of the long-term investor, say your mom, my mom, right? Mom, pa America, let's say they're in an IRA, let's say they have tax consequences, whatever the reason might be, but they don't want to get their stock taken from them, they got a decision to make. And typically that decision is centered on, do I roll it up and out, i.e. the call
Mm-hmm.
option, or two, do I buy back the call option at a loss and open up that risk graph and just take price appreciation in the short term and thus take on a little bit of risk in the short term as well. But that's the decision on the top side. On the bottom side, it's really a conversation that is centered around the efficiency of money, of what I call time value of money. When you're looking, let's say you wrote that call option here. Let's go back here. Let's say you write that call option right here at 66, and
Mm-hmm.
you bring in that cash flow, right? You bring in $275. I'm just assuming that's about what you brought in last week. And let's
Mm-hmm.
say you brought in that $275 last week. Okay. You had 30 days in the contract. Okay. You had 30 days in the contract. You were going to capture $275 over that 30 days. That's your expectation in the covered call. I'm going to make $275 over the next 30 days per contract, and I'm going to let this bleed out. Well, how does the value of that call option change? It changes based on not just theta, i.e. the bleeding out of the option,
Mm-hmm.
passing of time, but it also changes based on delta. And so when you're, and volatility and gamma, but primarily delta and theta. And so theta over the course of the last few days, let's say you've been in the trade about a week here. Theta, if you look right here, yeah, you've decayed about 40, $50 over the last
Mm-hmm.
week, I'd say. But there's still $275. You decayed about $50, probably not even $50 mind you. But let's just say it's $50. You still got $225 left in the contract at that point.
Mm-hmm.
Well, why then is the value of that 66 only 95 cents if it's only decayed 50 cents? Well, it also goes down in value based on delta. And so as the stock price went from 65 to 64 to 63 to 62 to 61 to 60, all of a sudden that value of that call option is dropping exponentially every single day based on delta. So the first dollar goes down, it loses $45. For the second dollar goes down, loses $38. For the third dollar goes down, loses $32, then $28, then $25. All of a sudden, now you got a delta of 21, which means the next dollar moves down, it's going to lose $21. And so it's moving down based on delta. And so now the question you have on Oxy right now is, okay, I sold this last week. I brought in $275 in cash flow. Obviously, there's only $95 left in the contract. And so I now have 24 days to capture the $95 when last week I had 30 days to capture
Mm-hmm.
$275, which means much like the central bank, you front loaded your cash flow, which means what are you doing? Go into a pause. Fed, go into a pause. You're now going to buy back that option at $95. And here's the kicker. If you're concerned about the market right now from an Oxy perspective, you would say this: I'm going to buy back the option at 95. I
Mm-hmm.
received 275 in cash flow. I'm going to buy it back at 95, which means you make, what would that be? Right around 180, right? 180 bucks. So
Yep.
you cashed in $180 on your position just in the last week. For us in the Tackle 25, it doesn't make sense to let the other $95 sit there and try
Mm-hmm.
to capture that over the next 25 days. Not when you could make a different choice. And so, like many conversations, when you're centering systems around rules, rules are there, but they're there to trigger decisions that you have to make. It's not as simple as, oh, if this happens, I'm out. That's a directional trade. If it breaks support, we're out, right? Now, these are cash flow systems. You have decisions to make. And because they're cash flow systems, you have time to make those decisions. They're a little bit they're a little bit less risky. You're dealing with cash flow. You're not dealing with the directional edge of the market. And so you basically say, okay, I have this decision to make. Do I want to buy back the option at 95 and reissue? And the
Mhm.
reissue means I'm going to come in and I'm going to sell that $60 call option or that $61 call option and bring in another $230 in cash flow instead of the 95, or bring in the original 275 that we got last week. And so that's the decision. And you make that decision if you're concerned about downward movement in price here. If
Right.
you're concerned about downward movement in price, you make that decision. Or two, you say, I kind of like the technical position of Occidental. I kind of like it sitting at this support level. Like, I feel pretty comfortable taking a little bit of short-term loss down to the 200-day moving average. If it breaks 57, I reissue. If it breaks 54, I reissue. But I'm going
Mhm.
to give this support level a chance. And then if we can get that price appreciation just up to the 90 EMA, then you reissue, because you're in a downtrend. You reissue
Mhm.
either on a break or you reissue on a bounce. And so it's just a conversation, but based on the price action, the efficiency of money would suggest that you buy back the option and then you make a decision. What I would do personally, I'd give it a day. I'd buy back the option, give it a day. I'd give it a day, see if you can get price appreciation. If it breaks 57, you reissue.